Afternoon, ladies and gents. It's Simon Brown here doing the introduction for today's webinar. Today we got Warren Peacock back. He's going to be doing us a presentation talking about position sizing. And position sizing is perhaps one of the most critical parts of trading. Something we've covered before, it's something we're going to certainly cover again. When Warren suggested it, I thought it was a great idea to reaffirm, but also I think importantly, just to give you an opportunity to throw some questions and to hear it from a different person's perspective. We're going to hand over to Warren now. We'll be run probably about 30 minutes, including Q&A. Warren, that should be coming through on your side.
Okay, I'm starting out with a great game to play. I'm sure that most of you have heard about it before. The coin toss. And it's a really simple way to bring across the idea of position sizing. In 100 tosses of the coin, the payout is as follows. 2 rand when you're correct, and so you win 2 rand when you are correct, you lose 1 rand when you are incorrect. Over 100 tosses, we will assume that we will have a 50-50 hit rate. So you'll be right half the time, you'll be wrong the other half of the time. The result is quite simply 50 tosses of the coin times 2 rand when you win, minus 50 tosses of the coin multiplied by 1 rand when you lose. And at the end of that, you would have a total profit of 50 rand. So you would have made, you would have made 100, you would have lost 50, total profit of 50. That's basically just to illustrate that you have a hit rate of 50%. As long as your profits are greater than your losses, you're going to make money. Now, in trading, the number of times that you're right is known as the hit rate. Can you see the screen? Okay, so the number of times that you're right is known as the hit rate. The payoff is known as the risk to reward ratio. In other words, the amount of money you make versus the amount of money that you lose when you're wrong. That is known as a risk-reward ratio. And the profit that you make is a function of the hit rate and risk to reward. Now, I've taken this as an excerpt from the workshop that I'm doing, so it's a really small part of the total picture, but it should give you a really good grounding to get started.
Warren, if I can just jump in there, we've lost your screen. I think you've deactivated. There we're back again.
There we go.
Perfect. Thanks.
Okay, now I can see. Sorry about that. So the money that you make is a function of the two together. You can't just have a high hit rate and then have a horrible risk to reward ratio. High hit rate systems are easy on the emotions. In other words, if I know, I'm going to be right one out of every 2 trades, it's very easy to trade that. But they seldom make decent money. In other words, if I do have a hit rate of 50-50, then my risk reward is 1 to 2. If I get it wrong twice in a row, I'm down, in a big way. And that also means I'm open to some sort of market fluctuation over which I have no control. Example would be something like Mittel. Mittel closed one day, opened up a week later, was down 25%. And if you were leveraged on that and your position was too large, you could have wiped out your account and owed your broker some money. The system's expectancy is a function of the hit rate, the risk to reward, including commissions and spreads. So a lot of people will do these calculations and they forget about the commission, they forget about a spread if you trade in Forex or an index. You have to take all 3 of those things into account to end up with a decent profit at the end of 30 trades. You need a minimum of 30 trades to calculate these things accurately and correctly. I'll put an example together. For those of you that are trading solely the index or maybe you're trading currencies, the principle remains the same. And I'll give you some of the specifics, but I based this around a straightforward share trade under leverage. And the example is quite simply, if I want to buy Anglos at 210 Rand with a stop loss at 200 Rand and a target of 230 Rand, my risk is 10 Rand per share and the target is 20 Rand per share. And if you can get this correct half of the time, you've got it made in trading. The only thing remaining now is learning how to play the game. In other words, how do you actually pick the trade? At the end of the day, if you have decent money management skills, it becomes a little bit less important as to how to pick the trade, and it's far more important to actually manage the risk, and then even more importantly is how to manage profit. One of the most common questions I get is, how do I know when to close out at a profit? So let's imagine that we have 100 1-rand coins in a jar, and that's your trading kitty. Every trade has two decisions associated with it. You can go long or you can go short. The second question is, how much do I bet? In other words, what percentage of my kitty do I risk on any one trade? Now, a lot of guys will just, they see a buy signal and they'll trade whatever feels comfortable that day. So today it's 500 shares, tomorrow it could be 2,000 shares, and the day after that it's 250 shares. And that's one way that you're going to get into trouble, because quite simply, if you win with 250 shares and you lose with 1,000 shares, you've totally thrown out your risk-reward ratio. So the two questions are, do I go long or short, and how much do I actually put at risk for any one trade? The decision of how much is one of the most important questions in trading. The trade size is the difference in rand value between your entry point and the stop loss which is appropriate. Now obviously there's more than one way to do it. I've chosen this way because it is the simplest and it's easy and quick to implement. So your trade size is the difference in rand value between your entry point and the stop loss which is appropriate at the time that you're ready to make the trade. Now remember, we chose a 50-50 with a risk reward of 1 to 2. So I'm right half the time, I'm wrong half the time. When I'm right, I make 2. When I'm wrong, I lose 1. And this concept is called position sizing. And that's what it is. We use the actual share to decide how many shares we buy, and it's compared to the price that we enter and the price that we deem a sufficient stop loss. Now, I'm assuming that most of us are using some sort of technical entry, and then this kind of thing becomes reasonably simple. You've got a support level. You decide that you get a buy signal from a candle or a stochastics, whatever you're using. You then have a defined stop loss at a close below that support level, and that would be the values that you use. I thought I would just bring in some probabilities as well. Remember, it's a 50-50 system, so the probability of a baddie is 1 in 2. So every 2 trades, 1 will be good, 1 will be bad. The probability of a cluster of 2 bad trades in a row, simple math, 1 out of 2 multiplied by 1 out of 2 means that 1 out of 4 trades I'm going to get 2 wrong, 2 right. And the cluster of 3 in a row is simply 1 to 8. So every 8 trades I'm going to get 3 in a row incorrect. This means that in a 50-50 system, if you put down 1/3 of your coins on any one trade, you will go broke every 8 trades. And that's straightforward math. There's no getting around it. You can be right 3 times in a row, you're suddenly wrong 3 times in a row, and you're out of there. Many small traders go broke with a great system because of a run of bad luck, and that is a mathematical certainty. And that run of bad luck takes them out before the good streak starts. So you have one good trade, then you have one bad trade, another bad trade, another bad trade, and you broke. And it's something that anyone that's in the education business and has been working with traders, that's one of the biggest reasons why traders go broke. And I know we call it, you're not putting the stop loss in, and I think most of the time it's because we don't really know how to put a stop loss in. We don't know how to calculate it. And I thought that today I would just bring it in, and this is a simple way, it's easy to implement. So let's go into the implementation. The first decision, how much money is in your account? How much have you got to trade with? Very few people decide on this. They see a buy signal at Anglos, they decide it's going up, and they just buy as many as they can get for their money in the account. Anglos doesn't go up, and before you can trade again, you have to top up the account. So all your money is tied up in this one trade, it's going nowhere, and you've got no more free capital. The only thing that affects the risk of a trade is the size of the account and then the size of the position for each trade. It has nothing to do with whether Anglos goes up or the Aussie goes up or Billiton goes down. It has nothing to do with that. Your longevity in the market is determined by the size of your position and the placement of your stop losses. If you do not decide and commit to an amount at risk, then the size of your position properly, then you're gambling, not trading. And this is an important aspect of trading. We often get told, oh, trading the market is just gambling. Well, this is the difference between gambling and trading. Size your position correctly according to the amount of money in your account, and you're now trading and you're no longer gambling. You go to the casino, you take $5,000, you sit down at the slot machine, you push the $5,000 through and you walk away. Now trading can be a little bit different. You don't have to blow the whole $5,000. You cannot control market direction, but you can decide upon your risk. The decisions are up to you at the end of the day. Any successful trader will tell you if you take responsibility for every trade, then you're going to be much better at it. Deciding that risk will keep you alive in a normal losing streak without too much drawdown and ready to profit from a winning streak that's around the corner. So we've spoken a lot about losing trades. You're 1 in 2, I'm going to be wrong. The other side of that coin, of course, is 1 in 2, you're going to be right. And if you get a cluster of 3 wrong, I'm sure many of you have experienced that. You have a trading system. We'll just use a simple something like a stochastic. You trade it the first time, you make money. You trade it the next 3 times, and those 3 are losers. And the next thing you do is you're changing your trading plan. So you throw the stochastic out the window and you switch it for a MACD or something like that. You get 3 in a row wrong and you change your system again. Now, doing that means that you can never be successful because you would never understand the system that you're using. If you control the risk, you can go through any continuous losing streak. You're going to get streaks out of 100 trades. You're going to get 5 or 6 or even up to 10 wrong in a row. And if that wipes out your account, well, then you've got to start all over again. So the most important thing in trading is to have enough money to trade tomorrow. In other words, if you control your risk today and you only lose a percentage of your account each time you're wrong, it leaves a balance for you to trade again. Now, I just assumed an account size of 100,000 Rand, and I've used a straightforward risk of 2% of capital. Now, yeah, generally traders will depend, it'll depend on the size of your account. If you've got R1 million or more, you don't have to risk 2% of that on any one trade. You could risk 0.5% and still make reasonable returns. If you've got a 20,000 Rand account, then 2% often doesn't give you enough of a move. So I think 100,000 Rand is a good place to start if you are going to trade shares on leverage. So 2% at risk would equate to 2,000 Rand in cash. If a sensible stop loss for your trade on Anglos is 5 Rand, so it's 5 Rand below your entry price, then you can buy 400 at 210 Rand. I'm going to give you the formula now so that you can work it out in your own trades as well. If the trade goes wrong, then you would have lost 2,000 Rand. If you know your maximum risk, you can calculate the size of your position. Okay, so we used 210 Rand entry. You could have a 5 Rand stop on that, and the calculation or the formula to work this out is as follows. Now remember that there are many ways to do this. So this would be the first formula. It's straightforward. Account size is 100,000 Rand. Your 2% risk is 2,000 Rand. To calculate the number of shares is simply 2% of the account divided by the risk, which was 5 Rand a share. So we put 2,000 Rand divided by 5 Rand stop loss equals 400 shares. So in other words, on this particular trade, you can buy 400 Anglo shares. You know your risk is going to be around 2,000 Rand. Now, unless you put if you're trading on a platform, you can put a stop loss in there and you've got a high probability you will be closed out at exactly 2,000 Rand. If you are trading discretionary stops, in other words, you decide when to close out, then it might be 2,000, it could be 1,800, or it could be 2,500 by the time you see it. So you can use this as a guide. If you are trading on a platform with stops in the platform, then you can fix it at that 2,000 Rand. Now, obviously, if your risk changes, in other words, your stop loss is not 5 Rand a share, it might be 3 Rand a share. You could then take a higher number of shares, and the same as if it was, the stop loss was 10 Rand, then it would be 2,000 divided by 10 Rand, which would give you a lot less shares. And all this does is it keeps your risk-reward ratio together. In other words, you're always going to be trading at that 1 to 2 risk-reward, and you're always managing a stock to be around 2,000 Rand, which is 2% of your account. That's a portion of the money management side of things. If you can control that, then everything else is reasonably simple. Deciding when to get in, if you know that you're only going to lose 2,000 Rand and that's acceptable to you, then it's a lot easier to enter trades. You don't have to, you don't stress so much that, oh, the stochastic's not exactly right, or that candle pattern is maybe not perfect, because you can limit your risk. And you know that you're going to get it right 1 out of 2 if that's your system. And, a lot of traders will have it maybe, you get it right a little bit less. So your hit rate is only 30 or 40%. You then adjust your stop losses to that hit rate. And I thought I would put in some position management, how to take profit. Scaling out is just one way to do it. Now remember, we bought 400 Anglos at 210 Rand a share. The approximate commission at 0.35% is a total of around 600 Rand. The first goal is to cover cost. So if you reach 216 Rand a share, you can close out 100 shares. So you sell 100 shares into the market. You now know that you've covered cost, and you can move your stop loss up to entry on the balance of 300 shares. So 210 Rand now becomes your stop. As the market moves in your direction, Anglos gets to 230 Rand, which was the initial target on this example. Instead of closing out the whole position, you could sell just 200 shares, bank that profit, and move your stop loss to within 3% on the balance of 100 shares. And that would be 3% on the share price. And then you trail it up. So as Anglos goes up from 223, there's a couple of rules around that you can create. You could say every 10 cents Anglos is in my direction, I will move my stop loss up, or every 50 cents or every Rand, I would move it to within 3% of whatever the current price is based on that step. So the balance of 100 shares, the initial stop loss would be 223 Rand and 10 cents, and then we trail it. So just a final result here. We bought 400 shares at 210 Rand. The exposure value was around 84,000 Rand. When we covered cost, we sold 100 at 216 Rand, taking 21,000 Rand out of the market. When we hit our target, we sold another 200 shares at 230 Rand a share, took 46,000 Rand out of the market, and we left the balance to run. Now, you'll notice I didn't make it 500 Rand a share. That's a little bit unrealistic. I just chose 5 Rand up, so Anglos had maybe a little blow off, went up to 238 Rand, 240 Rand, pulled back 3%. The stop loss was hit at 235 Rand, and we then sold the remaining 100 shares. And the total return, we would add up all those blue figures. We get a total of 91,100 Rand exposure, minus initial exposure of 84,000, and that would give us a gross profit of 7,100. Take away the cost, and you end up with 6,500 Rand net return. Now, that is obviously in a perfect world. It wouldn't be so round, nice and easy. But the idea is that if I buy a reasonable size position, I can scale it out. So as I'm right, I start taking pieces out of the market. The other way to do this is you might buy your first batch of shares, let's just say 100. You might buy your first 100 at 210. You might buy your second 100 at 215. your third 100 at 220, and so on. So as the market's going in your direction, you're adding more and more to the position. The biggest problem I have with that is at the turning point, you would have the most shares in the trade. So as it got up to 235 Rand, you would now be sitting with a full position of 400 shares, and then the market starts to move against you, and you end up with a higher percentage loss, and that ratio, I'm not too comfortable with that. I would prefer that I put my position in, manage the stop loss, 2,000 Rand in this example, and as the market goes in my direction, I take more and more stress off the table by reducing the size of my position each time it hits certain levels. You can use technical levels, you can use rule of eighths, you can use percentages. The idea is that if I am wrong, I've limited it to a 2,000 Rand loss. If I am right, I allow my trade to then run, even if it is only the last 100 shares. Anglos could have gone from 230, it could have gone all the way to 280, 300, 400 Rand, and at least you've still got those 100 shares in, and for you to lose all your profit takes quite a bit of doing. You'd have to really slack on watching your stops. And that's the thinking behind it, is that it allows me to actually let my final profit run as far as I can push it. So there's a few things. Entry is important because that would determine the number of shares that I can take based on a Rand value stop loss. If I put my full position in, I can scale it out as it goes in my direction, thereby covering cost. And as it goes up, I can take out another bank a good size profit, and I can leave a small portion of the account to run. The other option is to start with a little, and as the market runs in your direction, add to it. And yeah, that can be risky in itself, in that the turning point could be quite a hefty one. I hope that I've convinced you that if you watch and control your position size, then your trading is simplified. A little exercise you can do is take that previous example, put your numbers in, and then enter the size of the trades that you normally take. So on 100,000 Rand, you might find that you're actually buying 1,000 Anglos, and that 1,000 Anglos is a 5,000 Rand stop loss, which is 5% of your capital, which in my book is a little bit high as a percentage, but that would be the top of the range. What I come across the most is when guys are taking 3,000 to 4,000 Anglos, and they really do have an account that is too small for that. 100,000 Rand account trading 3,000 Anglos is craziness. One bad trade, one market hiccup, and you've wiped out the account. Why is it so difficult to translate this to our trading? It all looks nice and easy while I'm talking to you. You're going to go down, you're going to go back to your computer, you're going to sit down, you're going to work out your position size, and then you're not going to trade it. And the reason is simple. Why it is so difficult is that in every single trade, it's like that. To change your thinking, you have to look at the set of probabilities. And you require at least 30 trades to work out your personal risk-reward ratio and your hit rate. So you cannot think about trading in just one trade at a time. It has to be on a batch of 30 trades, minimum, for a statistical probability. And then we have to think about it in terms of probabilities. It doesn't matter what system you trade. It's going to get it wrong, and it's going to get it wrong in clusters from time to time. So any trading system, let's say it gets you 5 wrong in a row, you have to be able to look past that and know that the next 25 trades might be profitable. Of those 25, I'm going to have 5 that are great profit, and the balance are going to be reasonable profit, reasonable loss, mixed. At the end of the day, you want to know that when you are right, you're making more money than when you are wrong, on average. Okay, as Simon mentioned earlier, I am running a 2-day workshop. This was just a little excerpt from it. We will go in depth into stop losses and a number of different ways for position sizing. We will look at physicals, leverage shares, we'll look at some forex, and we'll certainly look at indices. Each one has the same or similar principle, but there are vast differences in the amount of leverage that you can take. So on the 28th and 29th of June, I'm going to run the workshop in Bedford View, and that's up here in Johannesburg. It's 4,000 Rand for the 2 days. You're welcome to contact me. My details are there. Hello, Simon.
Sorry, Warren, I'd lost connection there a moment, but I am back. Ladies and gents, let's take some questions. If you've got any, pop them into the box. A couple have come through already. Two of them comments from Khomotso saying really it's about sticking to your plan 100%. And an interesting other takeaway, most people go broke because they trade too large relative to the portfolio. Absolutely, couldn't agree more. Warren, two other questions. Talking about scaling in, you mentioned it. I've never been, like you mentioned, I scale out rather than in. And the other comment is would this work on Forex or leverage positions? My sense is it pretty much work across anything. I suppose if you're doing a leverage position, your down payment is smaller, but your rand at risk remains the same.
Okay, I did this based on a CFD or a single stock future trade.
Okay.
Yeah, if you're trading physical shares, then yeah, the thing changes a bit because you wouldn't have such a small stop loss if you're buying physicals. The principle remains the same across instruments. So if you're trading gold, for instance, the principle remains the same. If 2,000 Rand is too small, which often happens if you're trading, full size forex trades, 2,000 Rand is really not enough of a stop loss. It just means that your account is too small to trade that particular product. You can then reduce the size of the contract, so you could trade down from a standard to a mini to a micro. You would have to make your trading fit your capital. So where the big mistake is made is that I've got a 10,000 Rand account, I can trade Forex. The problem is I won't last very long.
Yeah, and the point there is rather...
Because your stop loss is going to be too small.
Yeah, rather trade something smaller rather than say, heck, let's try it, because the heck, let's try it is going to hurt you. Lauren is asking, does it work with index? Lauren, I'm assuming you're talking like index futures and the like. Absolutely, across products. Lawrence is asking, he's trading Aussie or SA40, move my stop to entry of trade is 75 to 80 points in my favor, and let it run. Do you think that's too tight? Lawrence, I'll give you a shout and then we'll see if Warren's got anything to add. I don't think it's necessarily too tight. We're in a tough market which is moving sort of range bound, which is making it harder than normal. But in index futures, 75 to 80 point stop loss is not unreasonable, assuming you're going intraday. What I typically do is I'm trading in a 15-minute chart, and I will move it, say I'm long, I will move it to the low of the previous chart as it carries on going my way. Warren, any comment on size of stops?
Yeah, look, the Aussie at the moment is range bound, and what I've found is if you try and push the trade, you end up just stopping out anyway. So what I've been doing is I'd rather be banking profits at 80 points and just closing out the entire position. And that would be for current market conditions. If that resistance breaks and the market actually pushes through this consolidation, then we might get back into a bit of a trending market where it actually pays you to actually open a position and then add to it as it moves in your favor. But you need a little bit of experience. The other way to do it then would be to let's say buy three Aussie contracts, and then as it gets to the 50-point profit, you close out one. As it gets to 100, you close out the second one, and you let the third one run. And the stop loss for that would be at the exit of the second one. And the target, you can just move it up every 50 points, move your stop loss up with it. But that is only in a trending market.
Yeah, that's a good point. In the current market, 70 to 80 points is good profit. And I typically scale out. I get in one shot, and even with my index trading, as I will start taking profits at sort of 80, 100 points, sell the first or the first pair, and the next 80 or 100 sell the second pair. In this market, you're not often getting to sell that second pair at the target, never mind the third one. Mike makes a really good point. The difference between an investment account with little cash in it and a trading account, you need cash to trade. Absolutely. My investment account is typically fairly fully invested. My trading account is typically sitting in a large amount of cash. Folks, I'm not seeing any more questions coming through, and we've run a little over the 30 minutes.
Oh, sorry, somebody fading out there.
Sorry, Warren, we're running out of time here. I'm not seeing any questions coming through. We'll call it a day here. Ladies and gents, thanks very much for your time. Warren, really appreciate it. This is a concept which is absolutely critically important. My sense is often that if you get this part right, in other words, trade size right, you're pretty much almost halfway home. In terms of trading, you can use something simple like a RSI or a MACD. Let's get the position size right. Warren, really appreciate the time. Thanks a lot.
Thank you, Simon.